How's it going, everyone? It's Griffin here, and I hope you're all having a great day as always. So if you've opened up your brokerage account at all lately or paid any attention whatsoever to the financial markets, then you would know just how frantic the markets have actually been over the past couple of months in the face of rampant inflation, higher interest rates, as well as overall just investor optimism in extreme fear territory. None of that is particularly new information though if you've been following the videos on my channel, but what is new are the tens of millions of new investors who entered the markets over the course of 2020 and 2021 who may now be feeling the wrath of their first market cycle and experiencing significant paper losses for the first time. Now, with the S&P 500 down over 20% from recent highs achieved in late 2021, well, we've officially crossed over into what's known as bear market territory, and again, that has a lot of investors worried about the integrity and value of the assets in their portfolio, along with just the overall health of the economy. In fact, analysts have now pointed out that this is officially the 27th bear market since 1929, and on average, bear markets tend to depreciate by around 35% on average, which would imply that the S&P 500 right now in this current cycle could still have yet to fall down to 3,100 lows. So yeah, it's definitely safe to say that the overall market euphoria experienced in 2021 and 2020 that was fueled by meme stocks, disruptive innovation, as well as 1,000 PE positions has absolutely shifted now to more defensive as well as income generating positions, which is super normal and indicative of a period of economic slowdown and fear as we're experiencing right now. That being said, if you have constructed your investment portfolio in a way that does take into account your age, your time horizon, your risk tolerance, as well as your goals, then I cannot stress this enough that market recessions are periods where the largest transfers of wealth and opportunities actually take place, not midway and at the top of bull markets when ironically it seems like the best time to invest as a result of FOMO, right? Fear of missing out. In fact, utilizing low-cost exchange-traded funds to consistently buy into the markets, as we'll be speaking about in today's video, is the exact advice that billionaire Warren Buffett has been giving for years to everyday investors. This chart right here even puts Buffett's advice to the test, where it highlights how consistently buying into the markets instead of trying to accurately time it is usually the best course of action for everyday investors, and even tends to outperform most hedge fund managers. All of this to say the 2020 flash crash did have some positives in that it got millions of people interested in saving money and investing for the first time. Ultimately, both of these are highly important if you aspire to achieve any type of wealth over time. That being said, now that the markets are shifting, well, this has a lot of investors realizing, well, hey, I probably approached the construction of my portfolio in a way that isn't, aligned with my goals, risk tolerance, and investment horizon. So as the title of today's video would suggest, we'll be looking over a couple of easy ways that you could approach constructing what's known as a lazy three-fund portfolio. And what does this mean? Well, instead of maybe buying 5, 10, 15 individual stocks like Tesla, ExxonMobil, and 3x leveraged Bitcoin funds, well, in this case, we will be looking at purchasing around 3 exchange-traded funds that are going to cover all of the equity as well as fixed income positions necessary in a well-balanced portfolio. And this is typically going to cover American stocks, American bonds, as well as international positions, or a secondary type of exchange-traded fund added to the portfolio depending on what you're after as an investor. By the way, if you do want some individual stocks though, make sure to check out the link down below for Wealthsimple Trade, where if you use that link, you can get up to 3 free stocks, each valued up to $4,500. But yeah, three-fund portfolios have really become a popular way to structure an investment portfolio over the past couple of years, both for non-registered accounts, but then also even registered retirement accounts, right? Really because they're just so low maintenance and come with extremely low fees as well. Let's now speak about the advantages of a portfolio such as this one, as well as who this could be suitable for. Hey, and really this could also be a great opportunity to think about, but then also reflect on your current portfolio structure, which I'm betting hasn't been rebalanced in quite some time. A three-fund portfolio though can be great because it offers low management fees, high diversification, low emotional upset as an investor, and then it also fully removes any type of human investment bias. So when you're investing in broad market exchange traded funds, well, you're inherently taking advantage of rock bottom management fees, right? Any type of fund or managed money is going to come with what's known as a management expense ratio. That's the case if you had your money invested with a manager or if you were looking at mutual funds. But exchange traded funds, specifically broad market ETFs that track indexes, typically have management fees that are below 0.1%. Some of the funds we'll be looking at later have management fees as low as 0.0%, which is literally rock bottom price points. And so by taking advantage of these, you're also looking at having exposure to hundreds or even in this case thousands of companies that you're exposed to, even with only 3 positions in a lazy 3-fund portfolio. So of course, these hundreds or thousands of positions result in smoother investment returns over time, typically speaking, than if you were simply holding, say, 5 stocks in your portfolio. I'd say the largest advantage, though, of this type of portfolio construction is just literally how simple it is to build in the first place, rebalance over time, and then also fully take any worry or stress out of investing, right? Most people who start investing in stocks, they're super excited at the beginning, but this ends up resulting in them being glued to their screen 24/7 and really worried and stressed out about market volatility. This is the complete opposite of that. Okay, now realistically though, who would this type of fund be suitable for? So first and foremost, someone who understands the importance of investing and how important taking advantage of long-term compound interest is, but isn't necessarily interested in actively buying and selling stocks, right? You're not looking to start analyzing positions all the time. No, you just want to sit back and relax, but you do recognize the importance of investing. Second, this is for people who are actually focused on creating income rather than focusing a ton of their time on trying to create higher investment returns. You're actually focused on your business, your job, something that's able to create money through the front door that you can then use to invest with. Next up, you understand the importance of long-term growth and compound interest. And finally, someone who wants to have zero stress whatsoever when it comes to their investing. All right, so you know what a 3-fund portfolio is and whether or not this is something that might be of interest to you. Let's now speak about how you can actually go about constructing one of these, right? And if you've been following me for the past couple of years, then you would know that to determine the asset allocation split, meaning how much you're going to be putting towards equity positions like stocks versus fixed income positions, well, you need to have a good understanding of your investor profile as well as your risk tolerance. And your risk tolerance and investor profile really have a couple of factors that come into play. The main ones being your age as well as your investment horizon. Your risk tolerance, really just how much are you willing to see the value of your portfolio fluctuate over time as you're investing. And then finally, really just your goals as an investor. Are you looking for long-term growth? Are you looking for dividend income or anything else, right? These are all factors that you need to take into account to really have a good understanding of your investor profile. I used to talk about that a lot. Nothing here has changed. You need to fully understand how you're going to construct your portfolio for your needs as an investor. So for example, if you're 50 years old and you're 5-10 years away from retirement, then the way that you construct your portfolio is going to be entirely different than someone who's, say, 18 or 20 years old. You just got your first job and you're starting to get some money rolling in, right? So the actual way that you're going to be allocating money towards fixed income positions versus equities is going to highly differ. And this all really comes down to your level of risk and investment horizon. Over time, generally speaking, with a long enough time horizon, equities tend to outperform any type of fixed income. And even, over the past decade or so, fixed income have come with significantly lower yields and returns than from 1970 up to around 2000. So that's also something to take into account. But really, I cannot stress the importance enough of actually understanding your investor profile. By the way, if you're not necessarily sure how to approach determining your investor profile, then I've got you covered. Go over to the top link in my description where you can access my full stock market investing course that I created over the course of 6 months. It has like over 7.5 hours of content on there, but what I'm referring to is the investor profile questionnaire that I created, where I have about, I think, around 10-15 questions that you can answer, and then this is going to give you a score. And based on that, I created sort of like a rubric where based on your score, you can determine your investor profile and really just your risk tolerance, all of which is going to translate over into better understanding how much you're going to want to allocate to fixed income versus equity positions. Yeah, check that out. It's completely free with a 1-month free trial on Skillshare. Ultimately, there are many different ways that you could choose to approach the allocation split. Some of the most popular are 80-20 towards equities versus fixed income, 60-40, even 30-30-30. Well, in this case, it would be 33-33-33. There are many different ways that you could choose to approach this. Again, all based on your risk tolerance and your investor profile. So make sure to go over and do that exercise before approaching the portfolio construction. Great, so we now better understand how to even approach this type of portfolio construction. Let's now speak about some concrete examples of exchange traded funds that could work in this context. Most of these are going to be Vanguard positions, but there are many other companies that offer these types of funds. In Canada, iShares offers many different exchange traded funds. And in the United States, you can also take a look at Invesco, and there are a couple other options. For US equities specifically, some popular options that I often speak about on the channel include VTI, which is a total US stock market ETF, or another option could be VOO, which is an S&P 500 ETF. By the way, make sure to check out this this video right here, if you missed it, I released it a couple of weeks back, and it goes over some great ETFs to actually take advantage of for long-term growth in the context of a market recession when these price points are depleted. Now, in regards to international stocks, which is most likely going to consist of a much smaller portion of the portfolio, that being said, some options you could look at include VXUS down in the United States. If you're in Canada, some options include VXC or VEF in Canada. Once again, these are going to be exchange traded funds that expose you to thousands of positions outside of North America. So we're looking at Asia, Europe, as well as other countries. And finally, in regards to fixed income exchange traded fund options, we could look at VAB here in Canada, as well as BND down in the United States, both offered by Vanguard, Vanguard US, and Vanguard Canada. And both of these offer a full picture of the bond market, right? So instead of strictly focusing on short-term, intermediate term, or even long-term bonds, this is a total representation of the bond market. Now, that being said, in regards to fixed income, as I was mentioning earlier on in the video, yields have been significantly lower over the past little while. And so what a lot of people are doing, especially if you have a longer investment horizon ahead of you, is actually even looking at lower volatility dividend positions, because the whole goal of fixed income is less growth over time, however, generating some income for the portfolio. And strategically speaking, the goal of the fixed income instrument is to balance out the returns of the equity positions over a long enough period of time, right? So for example, a dividend exchange traded fund would be SPHD. Again, I spoke about that in detail in the previous video that I spoke about regarding exchange traded funds, but that could also be an option, right? If you're, say, 25 years old, you have a 20, 30, 40 year time horizon ahead of you, looking at a dividend income ETF like SPHD that still offers quite a bit more stability than the broad market, this could be a great option while also generating some dividend income along the way. All that being said, the beauty here of a 3-fund portfolio is that it makes it extremely easy to rebalance over time and just stay on top of your positions. A lot of people start investing, they have 10, 15, 20 individual stocks in their portfolio, and then after a couple of months, it becomes kind of unachievable to stay up to date with what's going on for each one of these individual companies. The goal of an ETF portfolio like this is really, again, that passivity, hands-off approach to investing. I really hope you found value in today's video. If you did, please take a second to drop a like. It really helps my channel out. And don't forget to check out the links down below in the description to the free stock market investing course, where you can get a bunch of downloadables as well to determine your investor profile. And also, there's a couple links down there to open up brokerage accounts, and you can get some free stocks both in Canada as well as the United States. So make sure not to miss out. With that said, thanks a lot for watching today's video, and I will see you in the next one.